Hello, good to see you today. My name is Paul Brennan. I run King Street's European real estate business. King Street is a 22 billion global multi-strat alternative investor with a long history of investing in real estate. Our approach is to invest dynamically and opportunistically up and down the capital structure across asset types and geographies where we have an edge. The opportunity set has been growing as we start to see stress in credit markets broadly and the real estate credit market specifically. We expect funding needs to pick up over the next 6 to 12 months as certain owners are impacted by a combination of issues: loan maturities, covenant breaches, rising capex budgets, delayed leasing or sales. We expect continued reduction in transactional activity and limited availability of debt capital, especially for transitional assets. So we believe there'll be a larger opportunity set related to for sale housing and offices, for example, but ultimately expect the impacts to be far reaching across asset classes and markets, both in Europe and the US. Yes, we expect there'll be an increase due to a combination of factors: slower economic growth, increased uncertainty, and rising financing costs. There are many issues facing the real estate market today: inflation, labor cost, supply chain challenges, secular trends in office, retail, how we consume, reversal of demand pull forward during COVID, geopolitical risks, increased populist policies. So given this confluence of factors driving rates and slower economic growth, it's likely we will face an elongated credit cycle. We often say we're in a walk, not run market. So in the near term, we're most focused on sourcing situations where we can be a solution provider to high quality assets, providing tailored credit solutions with strong downside protection that can generate equity-like returns. For example, focusing on situations where capital is needed for quality properties, so targeting broken structures as opposed to problematic assets. Rising rates is one of the primary catalysts to increase the volume of distressed situations. Risk-free rates rising from zero or negative has caused a repricing of assets and causing many investors to pause. We think it will eventually lead to greater repricing of private market valuations, and in some cases will lead to lender-driven forced sales. We are starting to see the end of accommodative lending policies, the likes which we observed during COVID. So really leveraging the firm's expertise in complex situations, restructuring, bankruptcies, and foreclosures will be a valuable tool to capitalize on this growing opportunity set. Scarce financing available from traditional lenders, mortgage REITs who've been historically very active are on the sidelines currently as repo markets have dried up. So avoiding sectors with cyclical and structural headwinds, for example, covered malls, offices, markets with growing structural vacancy. We are quite focused on being invested in assets and asset classes where we think we can really drive cash flow growth. Investors and lenders are increasingly focused on green credentials, and this, coupled with increasing regulations, will drive incremental defensive capital requirements for older assets to stay relevant. There's still a large disconnect between public markets and private markets, and we expect further repricing in private markets. We really leverage the wider platform and keep a constant dialogue with our public markets team and traders to identify these trends and movements early. Moments of volatility like this have tended to be good for our business in terms of creating interesting opportunities for us to invest in.